Equalizing savings between spouses. What a mouthful, and what does it really mean? Today we're going to be talking about this particular subject. So I'm going to tell you a story about John and Mary. John is the director of a listed company. He earns a great salary and he's on track with his retirement planning. So he's saving well for retirement and for his other goals. Mary is at home. She homeschools the children. And she doesn't save at all for any retirement or any of her goals. At retirement, John will earn an income from his pension fund and his retirement savings, and he'll be taxed at approximately 41% on the income that he's earning. Mary, on the other hand, will not receive any income, so she won't be paying any tax. You might argue that they are married in community and property, and therefore it makes sense. And it doesn't really matter. But the fact of the matter is that is incorrect. That is not the way it works. If their savings were split between the two spouses in preparing for retirement, they could be saving up to 15% in taxes, which definitely makes more sense. How should they have approached this? They should have split the savings between the two spouses, meaning that both should save towards the general or combined goals that they've set. And not only one individual in his or her estate should be saving for the goals. What are the best products to invest into for a spouse that's not earning an income, like in our example in Mary's case? It depends on the specific situation, and we need to do an analysis to give advice. So this is just product information that I'm giving, but in most cases, your retirement type of products is tax deductible. So it makes sense to invest in a retirement annuity if you are earning an income and already paying tax. If you're not paying tax, meaning you're not earning an income, then something like a tax-free savings or a unit trust might be more suited to address that goal. So in John and Mary's case, if John was saving for his retirement goals in a retirement vehicle, he could have deducted the contributions from his income tax calculation, and he would have received the benefit there, whilst also saving for retirement. Let's say Mary also saves in a tax-free savings account and a unit trust for income at a later stage. Then they would have been able to equalize and balance their savings more between the two spouses. This also applies for people buying a house. If you're buying a house, you should consider the estates of both spouses and try to equalize the value of your estates. Meaning that if the husband has a lot of assets in his estate and the wife does not have a lot, then maybe a secondary property or an investment property or a discretionary investment should be done in the spouse's name. Remember, spouses can make donations to each other without any tax being attributed. So let's recap. It makes complete sense for you from a financial planning perspective to have joint goals as both spouses, and then also to have a joint plan to address these goals. If you are unsure about this, then I'd like to invite you to contact us so that we can go through this with you and to ensure that your financial plan is set up in a way that you are in fact equalizing savings for both spouses to get the maximum tax benefit at the end of the day.